I'm Chip Sawyer, Chief Investment Officer for Westover Capital Advisors. I'd like to tell you about a recent family road trip which struck a chord as an appropriate analogy to the journey an investor's taken so far this year. It's about an hour's drive from my parents' place in Maryland back home. A couple weekends ago, my 5-year-old daughter fell asleep before we'd even left the driveway. When she woke up, as we pulled safely into our own driveway here in Wilmington, she looked around bewildered and asked, "Daddy, are we there yet?" She hadn't noticed the rain, which we'd driven through for most of the 60-minute trip. An investor who fell asleep on February 24th, and who happened to wake up today, would look around just as surprised. She too would have missed the rain. Well, that's not entirely accurate. She would have missed a Category 5 hurricane, followed by a blistering heat wave. The S&P 500 index is currently trading not far from where it started the year. But that sleeping investor missed the fastest 30% decline in market history, which took just 22 days, and then the fastest 20% advance since 2008, which took just 12. The market has recovered all of its losses despite a June unemployment rate of 11% and a worrying rise in COVID-19 cases. It's no wonder that most investors are looking at the market today with confusion. It's the same exact look my daughter showed when she woke up from her nap. While there are several reasons for the market's astonishing recovery, the most important explanations fall under two categories: policy response and market construction. In 2008, the Federal Reserve responded to the financial crisis by expanding its balance sheet by about $1.3 trillion in the 9 months from March through December. In comparison, it took the Federal Reserve a mere 3 months to expand its balance sheet by $3 trillion from March of this year until June. That's 3 times the response in 1/3 of the time. Congress has had just as aggressive a response. They provided about $900 billion in stimulus during the 2008 financial crisis, and in response to the current pandemic, so far they've passed legislation totaling about $3 trillion. The fiscal response was so significant that the nation's personal income in April increased by 10.5% in the middle of a global pandemic. This has been a massive, historically aggressive policy response. And then there's market construction, which basically describes the fact that the largest companies have the largest influence on the market. Even before the current crisis, a major theme had been developing in the economy: the switch from brick and mortar to online and mobile. The stay-at-home orders we've been following for the past 4 months have pushed this movement into hyperdrive, as everything from grocery store trips to schoolwork has moved online. The companies that benefit most from more online activity or virus research are making new highs, while economically sensitive value stocks are still struggling. Amazon, Facebook, and Alphabet, combined with the technology and healthcare sectors, make up more than 50% of the S&P 500. These are the forces driving the market higher. As always, there's still plenty of concerns. There were over 74,000 new cases of COVID-19 in the U.S. a day earlier this month, a new record. There are almost 18 million unemployed Americans. There's massive social unrest in the country. There's an upcoming presidential election whose result, regardless of which party wins, will only make an increasingly divided country even more polarized. The volatility we've seen in the market is likely to continue, and despite what the latest breed of day traders say, the market does not always go up. Predicting the long-term damage to the economy and the speed with which it will recover seems an impossible task. So what's an investor to do? Follow my daughter's lead. Go to sleep and let us drive. Every day is a day closer we get to a vaccine. More than a dozen companies are working on vaccine. More than 20 companies are working on treatments. And we're getting much better at managing the virus as the mortality rate in hospitals continues to decline. The market's a forward-looking indicator and is becoming much more interested in 2021 earnings than it is concerned with 2020 results. You don't realize it when you're a kid, but the best part of being a passenger is not having to worry about driving through the rain. We are honored and actually enjoy driving our clients through both the storms and the beautiful vistas of investing. So if you're so inclined, go ahead and look out the window and enjoy the pretty parts of your drive, but feel free to close your eyes when the weather turns bad. We'll get you safely to your destination.